McMillan. Now, Larry is the president of McMillan Asset Management and McMillan Analysis Corporation, which he founded in 1991. He is the best-selling author of Options as a Strategic Investment, which was originally published in 1980 and is currently in its fifth edition. His distinguished career has taken two simultaneous paths. One is a professional trader and a money manager, and the other is a widely respected educator and proponent of using option strategies. Now, today, Larry is going to be talking about, could it really be 2020 all over again? And I think our previous speakers have also hinted at this as well. So he's going to be talking about and sharing the striking similarities between this and last year's markets. He's wondering, does this suggest that the current bull market will continue? And should we add a bearish position, consider bearish positions as sell signals rise? And with that, it is my distinct pleasure to welcome Larry McMillan to the room. Larry, hi, how are you doing this afternoon?
I'm doing good.
Hey, Larry.
Hi, Jeanette.
Larry, it's always like, who's the?
Yes, we do.
Great. Sound is good. You can take it away.
Okay, so as Raleigh said, the question is it 2020 all over again? Of course, if everybody's agreeing that it is, it won't be. But in any case, we'll analyze the data and see what we come up with. Just as a little background, we started out originally as a derivatives research firm, with writing newsletters, selling data, doing analysis. And then after the 2008 market crash, where we had some pretty good strategies in place for our advisory clients, we started managing money. So we're both a CTA managing futures strategies and an RIA, mostly SPY strategies, SPX. And then we added on, well, we've always had some education. We've added on a mentoring program in recent years. Our accounts were up for 2020, and they were really up all the way back in March. So we had an excellent volatility-based strategy then, and have continued on through the year. Our CTA accounts, which we call VolCap CTA, were up 24% on the year. Our newsletters had their best year ever as well, so we'll talk about those. But as far as what we're offering today, we're offering a free 1-month subscription to the Option Strategist newsletter through this link. And we will send you a PDF of this webinar if you sign up for the free newsletter as well. All right, let's get started. So there's 4 basic areas that we look at, although you'll see that we break these down into a number of areas. Mostly they're option oriented, but not all. And the most important thing, of course, is the chart of the market, in this case, the S&P 500. We happen to be right now in a very divergent state where the Dow chart is much better than the NASDAQ chart, and S&P sort of in the middle. So, but most of the time, the S&P 500 is the primary chart to follow. We'll also look at put call ratios. We'll look at market breadth, where we have some option oriented ways of looking at that. And then we're going to spend some fair amount of time on volatility, especially looking at VIX and other volatility futures and indices. So I have an important rule. It's actually a 2-part rule, but it's when the market is oversold, that does not mean buy. So that was clearly the case, let's say last March. We're really end of February. We broke down badly that first for the last week in February, which was the first week of the decline. And the market was already oversold, but it had a lot further to go on the downside. And more apropos to today, overbought does not mean sell. So we have a number of overbought indicators, but we need to wait for confirmed sell signals before acting on those. So let's just start out simply. Here's a 2-year chart of the S&P 500. And I just want to point out a couple of things. We had a very overbought condition in December of 2018, a very oversold condition before, right there before Christmas. And then, of course, last March. Now, as I said, just because it's oversold, we don't buy it. So you'll see later how we had buy signals coming in. Usually, we never catch the exact bottom. We're maybe buying in that area Now, conversely, we've got extremely overbought conditions right now. We had them last September as well. And then, of course, a year ago in February of 2020, which is really what we're trying to concentrate on here. So just as far as the S&P chart goes today, I'm saying the trend is in question a bit because we've tried twice now, we've come to new all-time highs and not been able to hold them. So there's resistance at the most recent attempt at a new all-time high at 39.85. There's support at 38.70. Today we probed down to 38.53. So that general area right in there is support. And then below that, there's an important support level around 3,700 to 37.25. So I consider a breakdown and close. So in most of these charts, I'm just going to say, trade above, trade below, but I mean close there. So we're looking for a close below 38.70 to break the uptrend in VIX or in SPX. And as long as that is in place, the uptrend, the primary indicator, which is the market itself, is still bullish. In 2020, of course, the market was trending higher and then broke everything all at once. I mean, we went from a pretty bullish but overbought situation on, say, a Wednesday to where the next Monday everything had roughly turned bearish. So that gap down, a huge gap, they're breaking the support levels, and that makes it difficult for the shorts to enter. But the market is in the business of making things difficult for people. It's not ever really easy. So another thing that we do on the S&P charts is we draw Bollinger Bands, and we have a way of looking at those. But we use what I call modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he needed to define what is the volatility of the market, and he used the standard deviation of closing prices as his definition. And that sounds pretty reasonable, but as it turns out that the math guys like Black and Scholes, who invented the option model, or other theoreticians, use a different definition, and they use the standard deviation of daily percentage price changes. So it's a slightly different number, and we therefore calculate our Bollinger Bands using that number, because everything that we're doing needs to agree with Black Scholes. Our implied volatilities, our historic volatilities, all that stuff would be different if we used the other definition of standard deviation. So we get signals when the market moves outside of the +4 standard deviation band or outside of the -4 standard deviation band. And we've had some great signals in here, and we've had just a number of excellent trades, but we've also had a number of false sell signals. So we modified it a bit this past year, and we created what we call McMillan volatility bands, which requires not only the sell signal, but some confirmation. So here's the chart. This, again, that's that same 2-year chart with the modified Bollinger Bands drawn on it. And here, because we're comparing 2020 and 2021, I'm only showing 2 signals. So we came outside the band right here, and well, actually late January of 2020. And this is the 4 standard deviation band right there, and then the one just inside that is the 3 standard deviation. It's a little bit tighter here to see that, but we moved outside the 4 and then back inside the 3. So that gave us this sell signal. And for a minute, it looked pretty good. The market went down, but then it went to new all-time highs. However, our stop on the system is a move above the 4 standard deviation band. You can see the market did not get outside that 4 standard deviation band. So that sell signal was still in effect when the market broke. All right, so now look at this here. We moved outside right here, moved back inside. That gave us a sell signal in early January. And again, for a minute, it looked good, but then it moved higher. Second attempt down, and then another new high. But all of this means that sell signal is still in effect because we have not moved outside the 4 standard deviation band. So those 2 setups look very similar. We know what happened last year. Doesn't necessarily mean that's what's going to happen this year, but that setup is the same. This is the same indicator drawn on the 1-year chart, and I filled in the other signal. So a red letter means a successful signal. So we did have a buy near the bottom. We had a sell last September. We had the sell that's from January that's really still struggling over here. And then these blue letters are false signals. So for example, on the way down, we had 2 false buys. And also here in July, the market went outside the 4, inside the 3, gave us a sell, but we never really capitalized on that after the first day, and it rose higher. So we've created what I said, the McMillan volatility bands, which requires a secondary confirmation of these signals, and that has eliminated any false sell signals along in here, including other times where it looks like you might have moved outside, but you didn't hold it. So this McMillan volatility band indicator, by the way, is available on tradingview.com, which is a charting service which is free, and then you can subscribe to our bands on top of that. So if this is the S&P 500, for example, this is not a current chart. I think it was drawn last year sometime, but you get these red arrows when there's a sell signal and a green arrow when there's a buy signal, and that works on any chart, on any time frame. So if you subscribe to that, you could trade 5-minute bars on the S&P futures if you felt like it. All right, so that's all I'm going to really say about the chart for right now. But the basic point is that the S&P chart has not broken down yet. It's attempted a couple of times, but it hasn't been able to do it. Now, another thing we look at is put-call ratios, and specifically we use the equity-only put-call ratio, which is all stock options that trade. We use that to predict the broad stock market. I'll show you why in a minute. Put-call ratios were invented by Marty Zweig back in the 1950s when he was getting the volume out of the ads that ran in Barron's on Sunday. They were at that time 6 or 8 broker dealers that dealt in options, and that they would advertise in Barron's, and they would publish how many puts and how many calls they traded the previous week. So he started adding these up, and he noticed that when there were a lot of puts trading, the market then went up, and there were a lot of calls trading, the market then went down. So it's a contrary indicator in that regard. And if there's too much put buying, then we need to be thinking about doing something bullish. And if there's too much call buying, the inverse. We'll define what too much is in a minute. But simplistically, let's just say we have IBM. At the end of the day, we sum up the volume that traded on all the puts. We sum up the volume on all the calls, divide the two, we get the put-call ratio. So put buying generates higher numbers because that's in the denominator of the fraction. Excuse me. I'm sorry, that's in the numerator. And so when there's heavy put buying, this ratio goes higher. But when is there heavy put buying? Well, usually when the stock is going down. So it moves opposite to the stock price. Similarly with call buying, that's the denominator, and that makes the ratio go down if the denominator increases. But when is the ratio likely to go down? Well, that's when there's heavy call buying, when the stock is going up. We keep a 21-day moving average just in case there's something to Fibonacci. And ideally, this is what you'd have. You'd have the stock price and the put-call ratio moving inversely to each other. Now, we publish about 650 put-call ratio charts on our website every day in a subscription area, but it's fairly cheap. I believe it's $200 a year or $25 a month. But you really need to look at the stock price and the put-call ratio together, because in some cases this configuration does not exist, and that's usually when there's arbitrage or perhaps a takeover or something like that. But in normal times, let's say the stock is moving down like this, and as that's happening, the people are buying puts, more and more puts along the way, and during the trend, the public is right, and eventually the put-call ratio tops out and creates a local maximum. A local maximum on the put-call ratio is a buy signal for the stock. Then the stock starts to move higher as people are buying calls, and call buying forces the ratio lower. Move over here to the left, ratio is going lower. Eventually, the ratio bottoms out in a local minimum and a local minimum is a sell signal for the stock. So what we're looking for in the put-call ratio charts is local minimums, local maximums. This is not a current chart, but on top is the S&P 500, and on the bottom is the equity-only put-call ratio. All stock options are traded. There's several million usually on a day. So you can see the inverse symmetry that exists most of the time here, and that's good. It makes the theory work. And that's why we use the equity only put call ratio to predict the broad market. So where do we stand? Let's start out just simplistically looking at 2020 and this year. We got a local minimum. This is a 1-year chart, so you really can't quite see where this is coming from. But we came down and formed a local minimum back in mid-January of 2020. And remember, a local minimum on the put call ratio chart's a sell signal. But as you can see, again, that was that thing where the market responded briefly and then went to new highs. So at that point, the sell signal it was premature at best. The ratio moved sideways, but then it was still in effect when the market broke and it captured a big loss there in the market. Similarly here, we move over to this year. And we had the ratio come down. Well, first it came down in late December. That one didn't pan out. But here in mid-February, again, a local minimum. That's a sell signal. Again, the market responded briefly, then moved to a new all-time high, and now we're muddling around. This chart's accurate through yesterday. And we're muddling around in this area right now, waiting for a complete breakdown. It's interesting to note, usually the put call ratios rise over time because more and more institutions figure out that they can buy puts for protection. But this ratio back in 2020, there in January 2020, was the lowest it had been in 16 years. But this year we completely outdid ourselves. The ratio dropped all the way back to where it was at the end of the tech boom in the late 1990s. So there has been a lot of call buying this year. By the way, also shown on this chart is the local maximum in the put call ratio right here. Remember, a local maximum is a buy signal for the underlying. Of course, that was a great buy signal. That came in right around, I believe, March 24th of 2020. We have some computer programs that aid in determining whether these are really local maximum or local minimum or just nothing, noise. But here's the current, all the signals shown for this past year. And you can see that there's been a lot of noise. The ratio dropped tremendously after the big market bottom in March of 2020, and call buying drove it down. And this is where it was. Now remember, that was a 16-year low. You can see this almost the entire part of the last 9 months or so has been spent below that level. And as I pointed out, this level right here was the lowest we've been since 1999. So there has been a lot of call buying, and that's no news to anyone if you've read anything about the market, you've read about all the sort of novice traders at Robinhood or whatever buying calls, and they're making money. I mean, you can be right. But there's been a lot of noise, and now most recently we're on sell signal. By the way, the red letters again indicate successful trades, the blue letters not. So just as an aside, there in mid-February when we were at the 1999 lows for the equity only put call ratio, the total put call ratio, which is the sum of all index and equity options, that was the lowest it had been since April 2000. And the CBOE equity only put call ratio, they published their own. The other chart shows all the option exchanges in the United States. I think there's 8 or 9 of them. So the equity only put call ratio, which is widely followed, is at the lowest ratio that exists in our database, which goes back to 2001. So let's just say there's been a lot of call buying. And typically, that's not a good thing. Eventually, the market is just too much, positive opinion reflected through all that call buying. Now, as computers came along, we were able to calculate another put call ratio called the weighted ratio. The other one, we were just looking at the volume. So the way we calculate the dollar volume of an option is at the end of the day, we take the option's price and multiply it by the option's volume. Now, we could do this tick by tick, trade by trade. Turns out that's a pretty expensive data set, and we tried that for a while. It wasn't giving us any better signals than doing it this way. So this is end of the day data suffices for this. So we make that calculation for every option. Then we sum up those multiplicans for all the puts separately. We do it for the calls, divide the two. And now we've got the dollar weighted put call ratio, meaning we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And in my experience, this is a more important number. The timing of the signals is very similar, but the magnitude is quite a bit different. So here you can see, for example, that sell signal on the left down in here last January, and again, this came down like this, was at about the 55 level, meaning $55 were being spent on puts for every $100 being spent on calls. That's an extremely low number, and it was in fact the lowest since 2004, just like its counterpart was when we just used volume. Then everything, that sell signal again was a little premature. Market went down briefly, then to a new high, but it was still in effect when the market broke. You can see here then public opinion changed, and we were almost at 200, meaning that $200 were being spent on puts for every $100 being spent on calls, and that's a crazily high number in terms of stock options. In stock options, usually there's more calls traded than puts on a routine basis. That was the highest it had been since the financial crisis, 2008. Anyway, moving forward, we actually went to a little bit lower low right there, but this year, the ratio hasn't been as low. We did get this sell signal here in mid-February, which we're operating on right now. And again, as we know, the market responded briefly with a sell signal, then moved to a new high. Why is this ratio not as low as the other one? Well, it really is because of these small traders. The small traders are buying out of the money options. And so while their volume may be large, their dollars are not necessarily in comparison to, let's say, more professional traders who are using in the money options. So the dollar weighted ratio did not drop as low as just the volume ratio, but they're still both very low and in very overbought territory. You can see here, though, that, again, this chart's up to date through yesterday. We're just now starting to break through those levels of last summer, but I would expect this thing to move on higher somewhere before it gives a buy signal. This is just that same chart of 2000, the rest of the data points filled in. You can see the weighted ratio is a little less noisy than the previous one. And this ratio right here, this sell signal in September, came at a slightly lower level, more overbought level than the one in 2020. But in any case, both these ratios are on sell signals right now. Last year, there were good signals as well. So while this one right now is having a little trouble gaining traction, we actually have implemented it using the QQQ chart because it seems to be a little more timed with that less bullish chart. Anyway, they are similar. They gave these sell signals. Market moved to new highs. We know that in 2020, things broke badly after that. We'll have to see what happens this year. Just one more point on the put call ratios. These are the CBOE equity only put call ratios daily. And 45 means that 45 puts traded for every 100 calls. So it's rare to see that daily number under 45. It's usually more like 65. So, that's typically where it is. In fact, some years there weren't any days where there was a reading of 45 or lower, and many other years there was just a few days. But there's a couple of years where there were more. 2001 had 18 days, and that led to a bear market in 2002. 2003 had 16 days, and that led to a flat market in S&P, and kind of a stealth bear market in small caps the next year. Then we stayed in single digits all the way till 2010, when there were 13 such days, leading to eventually a bearish market in 2011. But look at what happened last year. 67 days when the equity only put-call ratio was on the CBOE was 45 or below. And remember, there were a whole bunch of days there in March when it was very high because the market was getting killed. So that's nearly half the total of all 20 years put together. And in 20 years, there's only been 144 days with a reading of 45 or lower, and 67 of them were last year. So just by that alone, I would say things don't look so good for 2020. Now, I know a lot of people are justifying the call buying and, saying, the traders have learned this or that. Really, I mean, it's not different. It's just not different this time. So when there's this much, optimism in terms of call buying, then when the ratios turn up, the market will go down. So the ratios have turned up. NDX is going down. We'll see what happens with the rest. What do we buy when we get these signals, Bollinger Band signals or these put-call ratio signals on the broad market? Well, typically, first of all, let me just define something for you in case you're not aware of it. The delta of a call option ranges between 0 and 1. That's the percentage of the stock price move that the option captures. So if an option is deeply in the money, that is, its strike is well below today's current price, then the delta is near 1. The option is going to perform just like the stock. The stock goes up a point, the option is going to go up a point. On the other hand, if the option is way out of the money and say maybe expiring tomorrow, it has no delta at all because the stock could go up a point and the option won't even budge. So the higher the delta, the more the option behaves like the underlying. And of course, the lower the delta, the more speculative your option purchase is. So for those of you who are not really familiar with trading options, most option platforms will give you the delta as you're trading the option. Maybe you should check that, because if it's too low, that means you're probably being too speculative in your option purchase. So we tend to try to buy something in the money, or maybe even, slightly in the money, with a delta of 70 or higher, because I'm in the business of predicting where the underlying is going to go. I don't want to also have to fight uphill against the option price. So if I'm buying an option with a delta of 0.70 and I'm right about where the underlying is going, we tend to trade SPY options for these broad-based market indicators. Then I know that I'm going to make money. If SPY goes up a point and my option has a delta of 0.7, then my option is going to go up 70 cents approximately. Other things could affect that, but by and large, that's a pretty dominant figure. Now, if we're talking longer term, with some of those put-call ratio signals you see could be 4, 5, 6 months out, then I might just buy an at-the-money option, which has a delta of about 0.55. But even there, I'm still participating with the underlying, and I've paid perhaps just a little bit less than I would have for an in-the-money option, so it gives me a little bit of risk reduction. Now, what about spreading? If you watch these guys on CNBC, they're all spreading. Every trade's a spread. I'm just going to tell you right now, that's silly. No real option trader trades a spread in every situation. And I know they say, well, you're not risking as much. You're risking 100%, whether you have a bull spread or a long call. You're risking 100% in both situations. So if you're worried about dollar risk, then if you're going to buy 10 bull spreads, well, then maybe only buy 7 long calls. Same dollars, same percentage risk, 100. So that's not a valid argument. I know they use it, but it's not valid. So when do you spread? You spread when the options are overpriced. And we put up on our website about 2,000 volatility charts every day, and that's again that same paid subscription. But also once a week we put up free volatility information on our website for everything that trades options, so you can see the where the percentile of the option currently is, where it has been in the past, etc. That's just a a row of numbers, not the chart, but you get the idea. You can tell when the option is expensive or not. So for example, last February of 2020, when the market broke down and VIX went shooting higher, the options were immediately expensive. So it made some sense, you would think, to do a bear spread. But as it turned out, the market collapsed so quickly in March of 2020 that it just ran right down through your short strike and your bear spread. And of course, that limits your profits wherever that short option is. So, you know, I'm reluctant to do a spread because it cuts off your profit potential. But if I do, if the options are expensive and I do use a spread, then I have a couple of things I can do to counter the bad effects of running through the short strike. The first is widen the difference in the strikes. So right now, for example, if I'm buying a call spread, and you know, VIX right now is still around 20. So that's pretty expensive historically. So I think spreads make some sense right now if you're trading SPY. But widen your call bull spreads out to 13 to 15 points between the strikes. And since puts are even more expensive, on a put spread, you'd want to widen it out to 25 or 30 or maybe even more, depending where volatility actually is. Another thing you can do to counter the bad effect of the spread is if it hits your short strike, you're making money if it hits your short strike. But so sell the spread you've made money on and buy a new one where the long strike is at the money and then the short strike is again this far out of the money. In other words, you're rolling your spread. So those things will help counter the negative effects of having a spread in place, and while still allowing you to have one in place if options are expensive. All right, so back to the put call charts. I just want to show you a few individual stock and option put call charts. Now we treated it a little bit different for stocks and futures on the individual charts. Not only do I want the local maximum and local minimum to be my signals, but I also want them to be at the extremes edges of the chart. So for example, and again, you can't quite see this coming down here, but this is BP, British Petroleum. And in January 2020, we had a sell signal there, a local minimum on the chart. If we look back, that was in the below the 10th percentile of all previous put call ratio regions for the previous 600 days. And now again here just recently, same thing has occurred. This one actually happens to be in the 0th percentile of the last 600 days. The put call ratio has not been this low. There hasn't been this much optimism. And you'll see, if you look, you'll see many of the oil stocks and oil futures contracts and oil indices all have very bullish opinions in them right now. So of course, by the contrary nature of put call ratios, that's a sell signal. So we looked at the chart, and we first saw it about right there, but there had been a couple of support levels there. I mean, resistance levels, then a support. And so we said, all right, if it broke below that level, we'd want to be short, and it has. So we are now short BP, or actually long puts on BP. Workhorse, this is an interesting one. You can see it gave a local maximum. That's a buy signal. It took a little while for the thing to get rolling, but then it did. Then again, later, another local maximum, another pretty good buy signal. So now we've just recently, end of February, had another local maximum. So as we got that signal, there had been, it had fallen back. I don't think we actually noticed the signal till about right here. So as I mentioned there, we have computer programs that look at this and determining whether it's an actual local maximum or not, and didn't really determine that till about right there. At that point, it had run up to 18 and fallen back. So we said, all right, if it gets above 18, we'll buy calls, and we still would. But in fact, as you can see, the stock has fallen back, and so we did not take a position here. Another one, Eli Lilly, same sort of thing. We got a sell signal here in February at a very, very low level. But by that time, the stock had already bounced off this little low here. So we said, all right, if it breaks there, we want to buy puts. And in fact, it did on a gap there. It was an earnings gap. So we went long puts there. Again, these charts are valid through yesterday. So we're long puts on Lilly. Finally, I just want to show you this one. We haven't taken a position yet, but this is TBON futures. They, as you might expect, not too many bulls on TBON futures. So the weighted put call ratio has risen to 400, or well, 380 maybe, whatever the number is over here. Let's just call it 400. So $400 are being spent on puts for every $100 being spent on calls. That is a tremendously bearish outlook on bonds. And everybody feels pretty negative on bonds, but you can see they've already started to curl up. And so tomorrow in the Option Strategist newsletter, we are probably going to take a long position here, although I have to look at it a little more. But in any case, the put call ratio got up to very extreme levels and now has fallen back. By the way, once we put one of these signals on, then we use the put call ratio chart as our guide, not the stock price. Okay, the third topic that we look at quite a bit is market breadth. Wow, 5:42 already. Talking too slow. So a couple of things with breadth. We can keep a cumulative count of advances minus declines, or we can keep an oscillator. That's our oscillator formula there. Today's oscillator value is 90% of yesterday's value plus 10% of the difference between advances and declines. We can look at New York Stock Exchange data, of course, but there are things on there that are not stocks, or we can look at stocks only. And what stocks only do we look at? Well, since we're an option firm, we look at all stocks that have listed options traded on them. And that gives us a second data set, which spans not only New York stocks, but NASDAQ stocks and pretty much anything in between. So here's the oscillator back and forth. You can see that below minus 400, it's oversold. This goes back to 2013. Markets have been mostly going up since then, but really here in right before Christmas in 2018, and then last March, we had the most oversold conditions in history. Ironically, they were almost identical. But again, oversold does not mean buy. So we don't actually buy until it stops being oversold. And both these cases, then the market went on to become very overbought, which is probably pretty typical. But in the recent markets, the last few years, it's been even crazier. So we got extremely overbought, and same thing there. Most recently, we had a sell signal a few days ago, and it's a little bit hard to see, but we went into oversold territory as of Wednesday. And now today we had very positive breadth. So it's possible this popped up to a buy signal today. I'll have to check the figures tonight. I'll put a question mark with that. But you can see that, over time, we have a lot of overbought conditions, not so many oversolds. But in 2020, last year, you can see breadth was deteriorating, and that's this light blue area here, that the peaks on these things were deteriorating. This year, wasn't quite the same. I'd say breadth was a little bit stronger this year than it was last year, but you could probably make a case that there's deteriorating breadth there too. So I don't know. These don't look exactly the same to me. They're not as well positioned as some of the other indicators we talked about. So, we have it's a short-term indicator, this oscillator. So we have a number of signals, and some of them are small whipsaw losses, but we try to stay in line with it because it's called some big moves as well. Cumulative breadth is where we keep just adding up the total breadth every day. And in 2020, there was actually a divergence. Cumulative breadth had fallen off, but the stock market was going on to new highs. That's a very negative thing. A lot of technical analysts look for that. And we had that divergence in 2020. We don't have that divergence here. They've been moving together up through the middle of March. Both S&P and the cumulative indicators moved to new all-time highs together, and now they've fallen back off from there together. So another thing we look at is cumulative volume breadth, and that's just that same thing. We accumulate we take the volume on advancing issues minus volume on declining issues and accumulate that daily. And there's an interesting buy signal system here that if the cumulative volume indicator goes to a new all-time high, but S&P has not yet made a new all-time high, that S&P will follow. This signal has worked every time since 2000, the year 2000. Now, it's a bit of a trick in that it went from 2000 to 2015 without making a new all-time high because the 2002 and 2008 bear markets pulled it down so far from where it had been at the end of the tech boom that it took till 2015 to get back to there. But here's a chart of it in the last couple years, go back to 2018 here. You can see on the top is the cumulative volume breadth, and the little X's are new all-time highs. One of the more interesting ones was this past May of 2000, when you can see the stock market down here was still rising, and the cumulative volume had already gone to a new all-time high last May. So it was another few months of rally in the S&P before it also made a new all-time high. So that was a very strong and good buy signal. Most recently, we had a little one here end of last year, and now you can see that it made a new all-time high there in March, and so did the market. So nothing to see here, folks. Move along. But there, by the way, is that negative divergence I talked about last year in February. The market made a new all-time high, but the cumulative breadth did not. It came close, but did not. So that was a negative divergence. We don't have that this year. Finally, let's talk about volatility. Volatility in general has been bullish for a while now and still is. And this is probably, besides the S&P chart itself, this is definitely the most bullish set of indicators that we have. We've seen problems with all those other indicators. I would expect volatility would fall in line, but so far it really hasn't. So on the VIX chart, spike peaks are buy signals, but we also look at the trend of volatility too. Oh, by the way, if VIX gets very low, it's overbought, but not necessarily bearish by our theory that overbought does not mean sell. So here's the chart of VIX going back to last year, and all those Bs, we have a trading system based on the spike peaks in VIX. All of those were trades. The red letters are successful trades, the blue letters are not. So most recently, you can see that we had a buy signal here, and that was March 4th. Going all the way back to last year, we did not, you can see how much lower VIX was in 2020 than where it is now, about half, or well, no, it was around 15, now it's 20, but it was way lower than that and stayed that way. This little purple area here, though, is a significant thing. This is where the 20-day crossed over the 200-day, and also VIX itself crossed over the 200-day. That's a very negative setup, and when that occurs, that's a major sell signal. That occurred on February 20th of 2020, right before the break, which came on the 24th. This year, not setting up that way. First of all, VIX is much higher. Here's your 200-day. Here's your 20-day. Yeah, yes, it's possible that these things could both cross up above the 200-day, and that would give us a sell signal. But so far, that hasn't happened. And in fact, the inverse happened when we went back to where they both crossed below it. That took until last July because the market, because VIX had gotten so high, frankly. So it pretty much completely different if we're comparing VIX of 2020 with VIX of 21. In 2020, it was low and overbought. This year, it's much higher. I say abnormally high because at one point, realized volatility was quite low and VIX was quite high, but now that's gone away. The 20-day historical volatility of the S&P 500 is up to 19%. And that's usually, the 20-day historical is usually close to VIX, and VIX is near 20. So everything is copacetic there. It's just that VIX is 20. It's a lot higher than you would normally think. It would, as I said, it would be trouble if they crossed over. Now, the current state of VIX is this. We had that buy signal on March 4th I talked about. The 20-day moving average is below the 200-day, and VIX is below the 200-day. So everything is fine. Everything is bullish for the VIX indicator. And this is really what we call the trend of VIX right here. But some people are still worried that VIX is 20. What's it doing at 20? I mean, it's there now because the market has been very volatile since the middle of February, but it was there even higher for much of the bull market in 2020, and that worried people. But so far, those worries have been without foundation. So one of the things we look at is the actual products that you can trade on VIX, which in this case is the VIX Futures. Now, there's a typical bullish pattern that exists most of the time. VIX is trading at this level, and the first month future is trading at a higher level, and the second month higher than that, and the third and the fourth. And so the term structure of the VIX Futures slopes upwards, and they're all trading higher than VIX. So that's bullish when that happens, and that's the case most of the time. However, when it inverts, that's pretty negative. So like last year, in March, we had VIX here, and then the first future was here, second future, third future. And so the term structure sloped downwards, and they were all lower than VIX. That's a very bearish condition. And the transition between the two is usually a strong signal. So here's where they stand right now as of last night. VIX was at 2120. Today it closed down a little from there, 1981. But anyways, last night, the April futures closed at 22.97. So if we subtract off the price of VIX, we get a premium of $1.77. And you can see that these futures are all sloping upwards in price until about here. Then they kind of just flatten out after that. But they're all trading at a big premium to VIX. So this is all positive. These are all positive things for VIX. If you don't have the futures prices, you can use I call it the poor man's futures prices, which are the volatility indices published by the CBOE. We all know VIX pretty much. That's a 30-day index. But in addition, there's a 9-day, 3-month, a 6-month, and a 1 year. And you can see that they're also sloping upwards there, at least through 6 months. And so that's bullish as well. So this is all bullish stuff. And the construct is therefore bullish. It would, however, be a major sell signal if the front 2 months invert, if April rises above May. So how does this compare to last year? So this is again the same numbers we just looked at, VIX, and then the first 4 months. And last year on February 20th, 4 days, well, that was a Thursday. So really only one more trading day until disaster took place. The term structure was also positive. VIX was here, the futures were all higher and sloping upwards. But on that Monday, the front month crossed above the second month. So this one rose above this one. That was a major sell signal. By the way, in February of 2018, when the market also broke down very badly, that condition happened. The front month crossed above the second month 5 days before that market top. So it's definitely something we want to pay attention to. So right now we're constantly watching the April and May futures. And as long as May is above April, everything is fine. If April moves above May, it's time to head for the exits. So there's another realized volatility sell signal that we have in place right now too. We look at the historical volatility of S&P. If it falls below 8% and then rises back above 10, that's a sell signal. And we'd stop ourselves out if it fell back lower. So it occurred last year on January 29th, and it occurred this year on January 4th. And both times, the signal was still in place when the market broke down. So here's a picture. This is a 2-year chart. You can see on top here, this is the historical volatility of the S&P 500, and this is 10. So you can see it fell, you can't really see it fell below 8, but it did. It rose back above there. That was September. Here was last year, 2020, it rose above there. And even though, again, the same thing we're familiar with, market went down then to new highs, this stayed high. And so that sell signal remained in effect. Here's the one we got this year on January 4th. And now historical volatility has continued to rise up to where I said it's currently 19%. And even though the market hasn't really broken down yet, there were a couple other decent sell signals back here in 2019. So this is an indicator that also mirrors what was happening in 2020. So we know that that's a similarity. We also monitor new 52-week highs versus new 52-week lows, and our signal is very simple. If new lows exceed new highs, even for one day, and new lows number at least 100 issues, then that's a sell signal. So 2020 didn't actually happen until the first day of the breakdown. This year it happened 2 days ago on the 23rd, and has stayed there yesterday, the 24th, and now stayed there again today on the 25th. So this is a sell signal, and I don't know what the outcome is. Of course, last year it was a very negative outcome. So the current situation is a bit mixed. You know, the trend of VIX, the trend of the chart of S&P is bullish, but we've got these sell signals from the Bollinger Bands and from the Historic Volatility, put-call ratio sell signals. Brent oscillator, well, was sell signal, but the one is going to be moved to a buy today. New highs, new lows, sell signal. The trend of VIX, though, is bullish, and the VIX spike peak buy signal is still in effect. So overall, and the term structure is bullish. Overall, I'm still saying we're holding a core bullish position and trading small sell signals around that. Now, how does this stack up against 2020? Well, the similarities are that we have all these sell signals now and before the market broke, and the same thing last year. The volatility bands, the realized volatility, new highs versus new lows, put-call ratios, and deteriorating breadth. All those are the same. And last year there was a January decline, then we moved to new highs. So this year we did the same, and then we had a February decline and moved to new highs above that. But what's the difference? The major difference is volatility. Volatility is trending lower today, was not trending lower then. In fact, it trended broke higher, and it came from a much lower level back then. So it's easy to make that break out to the upside. Right now, it's difficult for VIX to break out to the upside. Cumulative breadth also was a divergence back then. It's not now. So there are similarities, but not complete exact similarities. And no two markets are ever exactly alike anyway. So that's not totally surprising. But I would say that the similarities are certainly cause for caution. And the number one thing we're looking for is a breakdown, of course, in the S&P chart and a breakout on the VIX chart. If those things happen, then I'd say there's a chance for a severe decline. So what strategy would you use if you're an option trader? Here's one that's pretty low risk that has some pretty high returns. It's called a put back spread. So we put this on a month out. So I'm sorry, 2 months out. So last Friday was option expiration. So we put this spread on using May options, long two of the deep out of the money puts and short one less out of the money put. The credit or debit on this would hopefully be near zero. We're going to take it off at April expiration, which is this blue line here. So you can see here's the zero line. Well, there's a lot of profit potential to the downside because you're long two puts and only short one. And if the market moves strongly higher, you didn't put this on for a big debit, so you have very small risk. The risk comes in right here if it starts to fall towards this strike, but doesn't really get through it. But even there, it's pretty limited. So I like this situation. The margin, by the way, is the difference in the strikes, $3,000 here, plus any debit you might have incurred to put it on. But this is a position we're carrying in the Option Strategist newsletter, and we will add others as we get more sell signals. So as I said at the beginning, we're offering a free 1 month subscription to the Option Strategist. It comes out every week, and we will send you a PDF of this webinar if you sign up for that. We also have a YouTube channel and 4 other newsletters, paid newsletters, which have been having excellent track records. This is our newest one, Special Situation Alerts, completely different from everything else we've been doing. But it's written by a guy we're associated with in London, and he's been hot. I'll have to say that. So there's my contact information. If you're interested in our money management, that's the URL right there. So Raleigh, back to you.
Hey, I tell you what, Larry, thank you for that fascinating, I mean, truly fascinating discussion on the differences between the 2 years and the steps and the analysis that you and your team go through as you assess the markets and make decisions on how you want to invest. Very, very valuable information. And I think you all wrap it up with the fact that is this year like last? Has the potential to be so? I know the speaker before you and some of the speakers earlier say that if we are going to see a sell-off, we could also see something similar to 2020, which is a very robust rebound off of that as well. Of course, these are things we just don't know, but I appreciate your comments on that. And also, as I understand it, the special offer that you have for your newsletter, which is 30-day access, which is a free trial to that, you know, people are going to get the benefit of being able to experience the kind of things that you guys do on a weekly basis. Is that correct?
Yes, that's right. So you'll get that's our flagship newsletter. We're actually in our 30th year publication of that.
My God, Larry.
Yeah, right.
Popular.
And I'm only 40, so no.
Me too.
Not exactly.
I got, you know, as you were speaking, I had this thought that this isn't your first rodeo. No. But anyway, thank you so much for your time today and for coming in and batting clean up for us, because it was a great way, if you will. It's a wonderful bookend. We started with Hubert on Tuesday, we ended with Larry, and we had 22 amazing people in between. I don't know if we could have done it any better, Jeanette and Pat. I don't think it's possible.
It's been a ride.
Except for next time.
Yeah.
Except for next time. Well, anyway, folks, I just want to bring the slide up here. That was Larry McMillan and his special offer, the free trial to his flagship, you know, newsletter, the Option Strategist newsletter. That's a 30-day free access to that. Go to westmarktrading.com/McMillan and you can see all that information. But it will also, if you go visit his site, you can see there's an awful lot of additional information that's available that Larry and his team put out there. Once again, they've been doing this for years. They are recognized experts in the market. So if you're intrigued in options, if you're a beginner, if you've been trading it for a long time or whatnot, there's the place that you want to go. And once again, with that, I can't even believe at this point in time that we're at the end of the event.
We did it.
But we still have more to come. We have